In this video, I'm going to show you 7 strategies on how to navigate bear markets and recessions from a trading and investing standpoint. A couple of videos ago, I asked you if you would benefit from this type of video, and overwhelmingly the comments were yes. So here it is. I aim to please, and more importantly, provide you with the most up-to-date, useful, no BS market information. Let's get right into it. 7 strategies for investing and trading in a bear market / recession. In a market where a classic 60-40 split between stocks and bonds is getting more hammered than it ever has in history, as we see the value of long-term bonds drop even further than the value of stocks, and in a market with so much uncertainty, with the Fed holding $9 trillion of assets on the balance sheet, the federal government holding $31 trillion of debt, an extremely illiquid bond market, inflation that is the highest that it's been in 41 years in this country. How should we go about investing in this bear market that is on the verge of a recession? Now, before I get into the top 7 investment and trading strategies, in my opinion, in a bear market recession, it's important to note that every bear market and every recession has its own set of circumstances, meaning there are unique reasons for why we are in that situation in the first place, whether it's over leverage in mortgage-backed securities, whether it is a .com stock market bubble, whether it's deflation or inflation. But it's important to remember that going back over 100 years, even after the Great Depression, the 2 world wars, the inflation that ravaged the 70s and 80s, the Gulf Wars, the S&P 500 has never had a negative 20-year rolling total return. And as the legendary Art Cashin says, if you are betting on end of the world scenarios, then who are you going to settle with? So if you think that this stock market crash is the end of the world, then really you have bigger problems to contend with. All right, so here's strategy number 1. Number 1 is weighted DCA. DCA stands for dollar cost average. Now, there is a traditional dollar cost average strategy where you put in a fixed amount on a regular scheduled basis, meaning say you drop in $250 every 2 weeks in the stock market, regardless of whether it's up and down. Now, that is a fine strategy. However, from my standpoint, because I know how to read a chart, and I implore everybody to at least learn how to read a chart basically from a basic standpoint, a weighted dollar cost average allows you to put in more when the circumstances are right. And contrary to what some might believe, the circumstances are never more right than in a bear market or a recession, because that is when stocks are discounted the heaviest. Now, without going into technical analysis, you can search for the Traveling Trader Technical Analysis. I have a whole free course on YouTube on how to do technical analysis for beginners. Aside from dollar cost averaging on a fixed schedule, when we hit major support points that are identified on a chart like this one, then I go in actually heavier. Now, this will all be based on budget, risk tolerance, time horizon, etc. Heavier could mean twice as much, could mean 3 times as much, could mean 10 times as much. That is up to you to determine. And just a little addition to that, from my standpoint, I only stick to quality stocks during bear markets and recessions. During bull markets, it's fine to speculate on companies, just like a lot of investors did in 2020 and 2021, because there's a lot of money to be made from the QuantumScapes, the Palantirs, etc. But during a bear market and a recession, you're trying to preserve capital. You're not really trying to bet on stocks hoping that you hit a hyper growth stock. Your number 1 goal is to protect your capital, not hyper grow your capital. And if you don't know how to do fundamental analysis, the bear market is the perfect time to learn. Basically, I want to look at a company's profitability, its growth, its cash flow situation, what is on its balance sheet, and also listen to a company's earnings guidance. See if they are well equipped to handle the upcoming situation or not. Number 2 is dividend investing. So right now, as of the time of this recording, treasury yields are paying historic rates that we haven't seen in over 20 years. Now, you could just put your money in something like a fixed income treasury. However, you're not building any equity. The government is just paying you 4% on your money, but you're not building any equity. So in my view, at this rate, looking for dividend yielding companies that are blue chips, that have a proven track record and a high dividend safety, especially those dividend stocks that are trading at a discount, you want to get more for your money if you can. So yes, it's all and well to invest in the mega cap tech stocks, and I do have a lot of mega cap stocks. However, there are mega cap stocks that are blue chips that are also high dividend yielding at the moment. One example is because of the current energy shortage, when XLE, which is the energy sector of the S&P 500, when that hit a support point around here, the dividend yield was over 4.5%. So back during the last week of September 2022, I actually made an investment in XLE because I did think that we were at a good discount based on the support level that we were at. I did think that there were some macro events that would actually elevate the price of energy in the near term. And I like the energy and oil companies that are within the XLE ETF. Plus, it was paying a 4.4% dividend. So not only did I lock in that 4.4% dividend, but currently from the time that we purchased it, XLE is up almost 24% at the moment. So not only did I build equity in that company, but I also am now getting that dividend yield every single year. Even if XLE's stock price falls below the point that I purchased it at, as long as they're issuing that dividend and that ETF has a high dividend safety grade, then I'm okay. And if you want access to all of our analysis, stock picks, dividends, options, futures, etc., link is in the description below. Spots do fill up fast every single month, so make sure that you secure your spot, book a call with one of our ambassadors, a free call, and apply to the Academy today. Would love to see you. All right, strategy number 3 is selling covered calls. What is a covered call? I know that some of you who have been programmed into thinking that options are bad, options can actually be one of the most friendly and secure ways to invest. You don't need to trade options or speculate on options in order to protect your investment in various ways. Hear me out. As of the time of this recording, Tesla is currently trading at $215. Let's say you had 100 shares of Tesla. And by the way, this applies to any stock that has options, which are most of stocks. So let's say that you have 100 shares of Tesla at $215, right? You make an investment today. You decide Tesla's at a discount. I like the path that the company is approaching, and I want to buy 100 shares of Tesla at $215. Well, what is that going to cost you? That's going to cost you $21,500. Again, this can apply to any stock, including cheaper stocks like Ford or whatever company you deem worthy of investing in. Now, imagine that you are expecting there to be some turbulence, maybe some stagnation in Tesla's stock price. So what you can do is sell a call. In this case, we can go out to January 2023. The time of this recording is October 2022. So we can go to January 2023. And as you can see here, the 250 call on Tesla, you can sell this for $12.60 or $1,260. So you have the 250 call, and we can actually sell this for $1,260 or $12.60. The reason that I keep saying $1,260 is because every options contract gives you the right to control 100 shares of stock, so you have to multiply this by 100. So in actuality, we're getting $1,260. Now you keep this money goes to you. So what happens here? If Tesla never hits 250 by January 2023, which is the expiration date of this covered call, you get to keep $1,260, no questions asked. You can then go back to the options chain and sell another call expiring 3, 4, 5 months out, whatever you are comfortable with. The further out you go, the more money you will get for that covered call, by the way. Now, if Tesla actually is 250 or higher, you don't lose money. You bought it at 215. But what the covered call obligates you to do if you get assigned is to sell your shares. So you would then be obligated to sell your shares at 250, but remember you bought them at 215. So how much profit are you making? Well, in this case, you are making 200. You're making $35 in profit per share, right? But you have 100 shares, so you're making $3,500 in profit. But guess what? That's not all. You also get to keep this 1,260. That never goes away. So you are essentially making $4,760, if my math is right, from being assigned that covered call. And like I said, if you plan on holding Tesla for the long term, and Tesla never hits 250, well, you just keep this money, no questions asked, and you go back and sell another call. So selling covered calls, if you have 100 shares of any stock, you are allowed to sell covered calls. You don't need a margin account. Is one of the most powerful tools, especially when you're expecting volatility, stagnation, or a drop. Now, the pot is even more sweet when you sell covered calls on dividend stocks, because remember, when you buy a stock that has a certain dividend yield, you are locking in that dividend yield at the price that you you bought the stock at. So if you buy a stock and the dividend yield is 5%, then regardless of whether the stock goes up and down, as long as the dividend is safe and intact and the company doesn't announce a retractment of that dividend, then you get to get paid 5% regardless of whether the stock goes up and down. So imagine you now lock in that dividend yield and you are selling covered calls on top of that in order to essentially make your shares work for you and potentially make more money on the shares that you own. And in our Trading and Investing Academy, we are selling covered calls and cash secured puts all the time, and we alert those. Strategy number 4, selling cash secured puts. Yes, another option strategy, also geared towards investment and not really trading. Now, if you have a decent amount of capital, this seems like a cheat code. This seems like a market cheat code. And again, those naive people that tell you that, oh, options are dangerous or stay away from options, they really don't know that options can be used as a very powerful tool for investment. Here's how crazy cash secured puts are. Let's stay on one of everybody's favorite stocks. You guessed it, Tesla. Let me go out to January 2023 and I'll draw this out for you again. So January 2023, again, this video is recorded October 2022 for reference. Let's go out to January 2023 and let's say, you know what, Tesla's a little expensive now. So I actually want to buy Tesla, but I don't want to buy it at this price. What can I do? Well, aside from buying 100 shares and selling a covered call, one other thing you can do is wait and get paid to wait until Tesla is cheaper. Yes, that's true. Such a thing exists. Again, Tesla right now, as of the time of this recording, is trading at $215. So let's say I don't want to pay $215 for Tesla. I want to pay $170 for Tesla. That represents about a 21% discount from here. So let's say that you are content on paying $170. You don't want to pay $215. Fine. What you can do is go out to the 170 put here and sell the 170 put for $9.15. Well, remember from our covered call example, you have to multiply this by 100 and you are actually getting paid $915 to sell this put. Now, what happens here? If Tesla never hits 170 by January 2023, you keep this entire amount and you can go ahead and sell another put after this expires. Or you can even close it out for profit before it expires if Tesla does not go down from here. Now, if Tesla is 170 January 2023, then you're obligated to buy 100 shares, but you're not buying it at 215. You waited and now you're buying it at 170. And the best part is you get to still keep this 915 and it has to factor into your cost basis. So in actuality, you didn't buy Tesla for 170 because you got paid $9.15 per share to sell this put. So in actuality, you actually are buying Tesla for $160.85 if my math is correct. All right, so that is called a cash secured put. Now, strategy number 5 is called the wheel. And essentially, you are combining a cash secured put and a covered call. What do I mean by this? Well, let's say that you go back out to that 170 cash secured put on Tesla. You decide, hey, I want to buy Tesla, but only at 170. I'm going to sell this put and get paid $915 for it. So let's say you sell the 170 put and you get paid $915 for it. And remember, this expires January 2023. Now imagine that Tesla doesn't hit that 170 put. Well, you get to keep this money and then you could sell another one and another one and another one. And you can keep on doing that until you eventually get assigned and collecting money until you eventually get assigned. It's literally free money if you don't get assigned. So what happens by the 4th, 5th, 6th time that you do this and you do get assigned? Well, now you're going to be assigned, let's just say 100 shares of Tesla at 170, plus you get to keep this 915. So your cost basis is really 160.85, right? And you buy 100 shares of Tesla here. So your cost basis is 16,085 on Tesla. Well, now you own 100 shares of Tesla. What can you do? Let's go back to strategy number 3. You can then sell covered calls against your shares. So in this case, if you bought it for 160.85, you can opt to sell, let's just say the 200 call on Tesla. I don't know what it would be priced because, you know, we're now speaking about hypotheticals in the future, but let's just say that it's priced at $10. Well, you can continue to sell the 200 call until you get assigned. So you do it once, twice, 3 times, say you get assigned 4 times. After the 4th time, you actually did this multiple times, collected that money, then you finally get assigned. Well, the shares that you bought at 160.85, you now get to sell them for 200 and keep the $10. So your sell basis is 210 bucks. Your cost basis was 160.85. So you actually made $49.15 per share. And that doesn't even count the number of times that you sold the puts before you got assigned, and then the number of times that you sold the calls before you got assigned. So the wheel strategy is an extremely effective way to rinse and repeat, especially on a stock that you want to own. All right, and investing strategy number 6 in a bear market / recession is a strategy that actually has been horrible to start the year, but if you actually started now, you have a much better chance of this working out. And that is because treasury yields are surging, and they are so high that bonds now actually pose a potentially good investment. So if we take a look at the bond rates here in the US, the 1-year bond is paying 4.6, the 2-year bond is paying almost 4.5%, 3-year bond almost paying 4.5%. So instead of putting it in a savings account if you don't need the money and you are liquid, instead of putting it in a savings account and getting less than 0.5%, well, the US government, which is the most secure investment that we have in the entire world, is paying you 4.6% for a 1-year treasury. Now, there are numerous ways that you can invest in treasuries. You can go to treasurydirect.gov, treasurydirect.gov, no affiliation with me. That is actually a government website where you can buy treasury bonds, notes, bills, etc. And you can also do so through a reputable brokerage like Charles Schwab, TD Ameritrade. They do also have bond buying features on their platform. So either treasurydirect.gov or your brokerage platform. And I've talked about this type of bond before, but an I bond, a savings I bond, which again is issued by the US government. This one is inflation adjusted. It's currently paying 9.62%. That rate will expire at the end of October, at which point a new rate based on the current state of inflation will be announced. So it's still likely to be high, somewhere between the 6 and 8% range. Nobody really knows until they actually issue it. But right now it is paying 9.62%, and you can lock this in for the next 6 months before the new rate takes effect. Again, you can buy a savings I bond off of treasurydirect.gov. Now, most money managers will tell you that a 60-40 barbell investing split is actually adequate for a long-term investor. There are so many opinions on whether this is too much or too little. Me personally, in my view, I actually have an 80-20 split because equities outperform bonds year over year on average. If you take a look at this chart here, you will see how stocks and bonds have performed facing one another since the Great Depression. Stocks have outperformed bonds by almost double. These are annualized returns, by the way. And since the pandemic, bonds have actually been negative and stocks have been positive. And that's because of the low Fed funds rate and quantitative easing that was implemented during the pandemic, which are now tightening. So you will actually see bonds start to perform better in the long term post-pandemic, post-recession. And although bonds are a much riskier proposition now than they've ever been, historically, they are the least risky investment that you have worldwide, not just in the US. And strategy number 7 is learning how to use options in a down market. Things such as buying protective puts, playing neutral strategies like we did with Tesla during earnings, and we've done that time and time again if you've been following this channel. You're able to set up neutral strategies where you think the price is going to be in a range, bearish strategies where you could buy puts, protective puts against your portfolio. Think of this like house insurance or car insurance, where you can risk just a little bit and potentially make back some of those gains as you want to hold your stocks, but the stock market is just not cooperating with your portfolio at the moment. I've done tons of videos on option strategies. You can YouTube these, so I'm not going to go into each one, but learning how to trade options, especially for the purposes of insurance, for the purposes of hedging, and also if you are interested in playing binary events like earnings, like the FOMC, the volatility presented there can really go a long way. We recently made 585% on SPX puts. We made 40% on a Tesla Iron Condor that we played during earnings. And I'm waiting for a nice run up here, a bear market rally here in the S&P 500 if we get one, in order to open up another portfolio full of puts once we get to around this resistance level here. Anyway, traders, hope this was helpful. If you got some ideas out of this, hit that thumbs up, leave it in the comment section below. Let me know which of these strategies are helpful. Which of these strategies are you currently doing? If you have any questions on any of this stuff, also leave it in the comment section below. I like to try to answer every single comment that I can. If you want access to the Academy where you get all of our trade ideas, our analysis, our weekly reports, you get access to the options day trading course, to the day trading course itself. And I also do an interactive Zoom call with all members every single month where you get to ask me any single question about trading, technical analysis, fundamental investing, bonds, options, stocks, futures, etc. And I try to respond to them. And we also have thousands of traders talking about trades all day, every day. So go ahead and book a free call with one of our ambassadors. Again, spots go fast every single month. So secure your spot today and apply to the Academy. Would love to have you. Stay safe out there, traders. Peace.